electronic signature company DocuSign is still down over 68% off its all-time highs reached in 2021. In this video, I'm going to make my case for why DocuSign stock at current prices is an excellent buy for investors in 2025 and beyond. I'm going to share with you some of the critical financial metrics from DocuSign, including its revenue growth, its improvement in cash flow and operating profit margins. And I'm also going to share with you valuation metrics, including the forward price to earnings ratio and my discounted cash flow model for DocuSign stock that all point to this stock being undervalued. So let's get started. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So you can see here, even though DocuSign stock has had a good year in 2024, bouncing up off its lows, it's still down significantly, over 68% off its highs it reached in 2021. Of course, 2020 and 2021, DocuSign surged because people were avoiding each other, and one of the things that was unnecessary was to come together to sign documents when the technology existed to sign documents electronically. And so it was a no-brainer. And even now, even though we're not in a pandemic, signing documents electronically is a no-brainer in 90, 95, 97% of the cases. There's only few cases that I can think of that you don't want to sign documents electronically when you need the highest security in those signatures and you need that privacy, security. And that's not very many signatures if you think about the overall market for signatures worldwide. Now, one of the reasons why DocuSign stock has remained undervalued is because the market for electronic signatures is not a large market. This isn't a company that's going to grow 10x from where it is today. It's not one of those explosive areas to experience rapid increases because the market overall is small. Still, DocuSign has been delivering revenue growth even though it experienced that huge decline. Well, it was partly because it had a surge so significant in 2020 that it was inevitable that it would slow down revenue growth following the economic reopening when signatures in person regained some market share, even though, again, I don't think that it should. I don't think any business should do signatures in person when electronic signature is an option for so many reasons. Adding to one of the more important reasons is convenience. Why make your customers come in person to sign documents when they are going to be annoyed about having to come in person to sign documents, and you might miss sales? If you tell a customer, oh, by the way, in order to complete this agreement, you have to sign on the dotted line and you have to come in person, the customer might say, you know what, no thanks, I don't really want to buy this, whatever it is I'm buying, all that much. I'll just much rather not buy this product at all. And so there's several reasons why you want to do that. So DocuSign, in the most recent quarter, revenue growth accelerated to 7.8%. And in the most recent quarter, management also demonstrated or showed investors that the contracts for billings, which are contracts that DocuSign signs, uh, inevitably, and then it eventually becomes revenue. So billings eventually turn into revenue, and the billings growth for DocuSign was exceptional in the latest quarter. That's why if you had been following, you'll have noticed DocuSign stock surged in the last month or so. It was because of that number in the earnings report, in the latest earnings report. That was excellent. So more impressively than the company's revenue growth, which admittedly it's not explosive, is the improvement in cash flow from operations. The company generates 33.65% in cash flow from operations to sales, which is more than 4 times the number it was generating in 2019. And this number continues improving. This is not a capital intensive business. Once the company invested in the research and development to create this technology, it didn't need to put all that much capital back into the business. It does need to invest in research and development to add incremental services to improve the technology here and there on the margins, but the bulk of the investment to create this technology is behind it. And so right now it's all about maintaining it, hiring the sales force, getting people involved, talking to customers, convincing them to go with you and sign documents and increase the amount of documents they agree with you and retaining those customers and serving those customers effectively. Similar story with DocuSign's operating profit margin rising to 6.15%, up from negative 60% in 2019. As the revenue has increased, the company has demonstrated operating leverage where revenue increases and costs remain relatively flat, and that creates that gap between revenue and cost, which creates profits on the bottom line, which is what investors look for when they're investing in a company. All that leads to a remarkably strong return on invested capital of 64%. Again, this metric improving significantly over the years for DocuSign. And it's because of the leverage in the business. Doesn't need to spend all that much money to retain customers, to grow to new customers, right? And that leverage creates this gap between the invested capital and the return on the invested capital, which is a great reason why DocuSign is a good investment for buyers. I mentioned that the company is not going to grow explosively. According to Wall Street analysts, they think its free cash flow is going to rise from 850 million in 2025 up to 1.31 billion in 2029. So roughly 30% increase in free cash flow over these next several years. And you can understand why I've been arguing that competitors that could enter this market will not be very interested in entering this market. It's not a massive market with lucrative opportunity. It's a solid market for the players that invested. It's a niche product that DocuSign has carved out for itself, and it will likely retain this large market share it has established in this market. Sure, a competitor might jump in and threaten DocuSign's market share, but that's unlikely given the characteristics of the market. There are much more lucrative opportunities that the larger tech companies will go after, in my opinion, rather than going after the electronic signature market, which is estimated at less than $85 billion in annual spending worldwide. So now that we've looked at the characteristic, let's look at valuation. And when measuring by a forward price to earnings ratio, DocuSign is trading at a forward PE of 26, which is relatively inexpensive according to its characteristics and its improvements on cash flow, return on invested capital, and operating margins. But that's only one way to look at a valuation. I also like to look at the discounted cash flow to determine if a stock is undervalued. And my intrinsic value for DocuSign found that it's about 30% undervalued. Its intrinsic value per share is $129 according to my estimates, and the current market price is $98. So for all of these reasons, I think DocuSign is one beaten down growth stock that investors can add to their portfolios before 2025. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.